Matt Justice here for Tackle Trading and Trading Justice to do a video on Decker and trading Vega-based strategies. Now remember, when you're very new to the market, it can be sometimes difficult to comprehend some other strategies out there, but it's a big market. There's lots of strategies, there's lots to learn and everything else like that. You basically have three types of strategies. You have what is called a delta strategy, a theta strategy, and a Vega strategy. Delta stands for direction, so when we buy a stock, that's a delta strategy because it's got to go in your direction. Theta stands for time. That would be like credit spreads, naked puts, making money based on the passage of time. And Vega stands for volatility. Now, all of these things, types of traders and trades are really cool and really good, and you should put them into your arsenal of trading strategies. Right now in the marketplace, it's a little difficult to assess the direction in the market given the uncertainty, given the news out there, given everything out there. It's really hard to trust what's going on in the market, and so it's been a little more difficult to trade in this environment. And so one thing that I'm really kind of working on right now is switching my trading from delta and theta. Theta volatility is really low right there. It's kind of hard to get good credit spreads, and delta is having a hard time with the determination of probability. So Vegas strategies right now though are really popular, and this is the right time to start getting into some Vega based strategies given the fact that volatility is at historical lows. You can get into options for very cheap, and volatility is still going to increase. It's still going to increase coming into earnings. And so as you can see down here, we're looking at DECK. We're looking at DECK. Decker Outdoors right here. This is a stock that is fairly consistent when it comes to volatility. Down at the very bottom here, this is implied volatility. As implied volatility rises, the value of options also will rise. So again, what we're going to do is we're buying when volatility is really low, and then as you can see, every time before earnings, what happens? Here's your earnings announcement. It rises. After earnings, it falls. Here's your earnings announcement. It rises. Then it falls. Here's your earnings announcement. Here's your earnings announcement. Every single time it will rise coming into earnings, and then it will immediately come out. It's called the Volatility Crush. So what we're going to do is we're going to build a Vega-based trade, which is a bi-directional trade, because again, I don't care about the direction of DEC right now. I don't care about that in any capacity. I care about making money, and so I want to do something that is bi-directional that will benefit off DEC going up. So there's two strategies that I really could focus on here. One is a strangle, the other is a straddle. We're going to go out to December because we're going to hold for about 30 days. We're going to go all the way out to December, and I'm going to go buy that one right there. It's the 87.5 put option, and then I'm going to buy this one right there, which is the 110 call option. So as you can see, I'm working out of the money. So we're going to right click on one of them. We're going to buy. We're going to say Strangle. And we're going to change the contract on the call side to reflect the one we're going to buy. That's the 110 right there. And we're going to pay $5.63 for one contract. Now let me switch it over to a risk graph that I really like. And what we're going to do is we're going to say we're going to buy one, we're going to buy one. We're going all the way out to December, and I want you to show you what volatility is going to do. On the call side, we were looking at the 110. And on the put side, and that's all risk graph is, it's kind of our little calculator. On the put side, we're going to 87.5, and we're going to apply it. Now what you're seeing here is you see multiple different lines. The black line right there, that is your at expiration. I am not holding this till expiration. All I'm doing is going to hold it till maybe a week before earnings. The blue line is real time, and what I want to show you is look what happens to the blue line if volatility does in fact go up. And so coming back over here to the chart, volatility is currently about 2.8. We're expected going into about 51. That is right around a 60-70% increase in volatility. So let's go back to our risk graph real quick, and then let's see if volatility does shift where we think it will. Now, just based on volatility, what happened to the blue line? The blue line started going up, and as you can see on the right-hand side, what's happening? Well, we gotta have theta too. Theta happened. Okay, so over here, the cost of the trade is $562. If we see the volatility increase, and that's it, you know, we got time, we got volatility. If we see the volatility increase, the contracts will go up in value about $362 per contract. On 10 contracts, that is a $3,620 gain. And what happened? All we had was volatility go up, ladies and gentlemen. I'm looking at these right now because I think they're the best types of trades. I'm looking at FFIV, First Solar, GMCR, CTXS, Decker, and Tesla. To name a few is what I'm looking at. Wrote about it in the Tackle Trading Scouting Report today. As well, talked about my expectations on the volatility increasing and whatnot. Happy hunting out there, guys. There's some fantastic trades. Go ahead, take some action, and have some fun.